Good evening, everyone. I hope you all are on the track of revising all your provisions regularly and also practicing your different sums from different topics, including taxation, including all your other subjects, so that nothing is left out. And in case you have any queries, you have any challenges, you can immediately get it cleared from your respective faculties. Students, it is very important that you are constantly in touch with all your provisions, specifically income tax, because there are multiple rounds of revision required. As you would have experienced by now, that there are varied topics having hundreds of provisions, exceptions, carve-outs. So in order that you are able to have a proper hold of it, it is very, very, very important that you do not miss the track. And for that, you are regular in your revision, in your practice. So let me first start by taking your questions, if any. So yes, very good evening, Gautami, Vishakha, Anchal, Barna, Dhanlakshmi, all of you all, very, very, very good evening. So I have a question right away from Gautami. If assessee chooses actual cost and not economic, then can assessee take COI, which was done? Yes, very good question, Gautami. Unfortunately, no, because these are two independent provisions. So if as a cost of acquisition, you are taking the cost of acquisition on 1st April 2001 and not the FMV, that is done. Then when you come to cost of improvement, it is an independent provision. So you have to ensure that it is to be applied independently. So unfortunately not. So it is better that you take the higher of the two, cost of acquisition or FMV on 1st April 2001, and all improvements post the 1st April 2001. Is this clear, beta? Yes, students. Any further questions, students? No? Okay. Take a screenshot of this. So today what we are going to revise are three topics combined, and they are going to be very interesting. Yes, Anchal, please tell me.
Sir, actually, I have doubt in that.
What, beta? Sorry, beta, we have lost your voice. I am unmuting you again. Please repeat.
Sir, just a second.
Yeah, sure.
Yes, sir, in section 62.
Okay. Please ask me. Tell me, what is your doubt?
Actually, they have written Mr. Rajesh transfers his house property to a trust for the benefit of Ramesh till Mr. Ramesh till his death. But how is profitable for Mr. Ramesh?
How it is profitable for?
Mr. Ramesh, because Mr. Rajesh is transferring property to trust.
You are reading this from where, beta?
Sir, in 4.5 page number.
Module?
Yes.
So students, we are revising three topics today. One is clubbing, one is set off, one is deduction. So even if you have any doubts, you can please raise it now so that I can discuss with you and I can clear your doubts. So are you talking about this, beta?
Yes, sir.
No.
4.5 page. Yes, example that.
One second. Is this the case? Income arising from revocable transfer?
No, yes, yes. Section 60. Yes, this example, sir.
Which one? This one?
No, 4.5 page number.
Okay, 4.5.
Yes,
This
yes,
example.
yes.
Okay, so what is the example? Mr. Rajesh transfers the house property to a trust for the benefit of Mr. Ramesh. This is a situation of irrevocable transfer till the death of Mr. Ramesh. Hence, till then, the income from house property would be taxable in the hands of the transferee, that is a trust. However, after the death of Mr. Ramesh, the income from house property would be included in the total income of Rajesh as on that date. So now what is your question, Anchal? See, what is given here? We are talking about section 61. Section 61 clubbing is attracted whenever you have even transferred your asset, but the transfer is revocable. So let us say I transfer my house property to you, but in the agreement I have written that whenever I want, I can take back the property. This is what is
Yes,
called
sir.
as revocable, right? Now,
Yes,
if your transaction or your transfer is irrevocable, then clubbing does not happen. This is the rule, because clubbing happens only when the transfer or the transaction is revocable. Now, when the
yes,
transaction will be said to be irrevocable, or when clubbing will not be attracted, that is given over here. So section 16 will not apply to any income arising to the person if there is a transfer by way of trust which is not revocable during the lifetime of the beneficiary. So I have transferred the property to the trust. Let us say the trust is for your benefit, and the condition given is
yes,
until you are alive, I don't want anything. But after your death, the asset should come back to me because I am transferring this exclusively for your benefit. So until you are alive, the asset will remain in the trust. Whatever benefit arises will be your benefit. I cannot take it. But if let us say you die and I'm still alive, then the property which I have given to the trust will come back to me. Now, here it is a revocable transfer, but the revocation is on a future date. And in the entire period till the date I have transferred and the revocation happens, in this period, since this transfer was made for your benefit, until you are alive, I'm not going to take it back, then such transfers will not be clubbed. Is this clear? Firstly, so I'm first explaining you the provision.
yes,
Is the provision clear? Now we
yes,
come to your question. Now, in this example, let us say I am Rajesh, you are Ramesh. I have
yes,
transferred my house property to the trust, and I have said that it will be remain in the trust till you are alive. Now, this
yes,
situation is of irrevocable transfer. Why? Because whenever I
yes,
transfer and I put a condition that until you are alive, I will not take it back. So it is as good as irrevocable until your death. In such
yes,
cases, clubbing will not happen. So that is what is given. Hence, the income from house property would be taxable in your name. So it will not be clubbed. This is the first
yes,
part,
yes,
right?
sir.
Now,
Yes,
let us say you die and I'm still alive. Now, as per the terms, what will happen?
yes,
Since after your death, I am now having the power to take back the property from the trust. Now the transaction becomes revocable because it was irrevocable till your death. The moment your death happens, I am able to take back the property. Correct?
yes, sir.
So now thereafter, after the death of Ramesh, the income from house property would be includable in the total income of Rajesh,
Yes,
because now it has become revocable. Correct, Beda?
yes, sir.
Yes. So is this clear?
Yes, sir.
Okay. Gautami has another question relating to capital gain. She is asking, sir, how to identify if self-generated asset is long-term, short-term, because there will be no period. Good question, beta. See, so let us say self-generated asset. Normally, the common most example is goodwill. So how goodwill gets self-generated? It gets self-generated over the period of the time I'm doing that business or profession. So let us say I qualify in this recent result. I start my practice from 1st June, 1st July 2026. After 5 years, when I'm now transferring this practice to you, I'm now charging you goodwill. Now, how this goodwill has come? This goodwill has come over the period of these 5 years. So, the life or the period of holding of the goodwill, which is a self-generated asset, will be counted from the date of starting of that business or profession. Fine, beta? Yes, clear? Great. Yes, others. You can first raise the question, then we can go to the examples. I'm okay with both. In the meantime, if you have taken the screenshot, you may start reading this. Sorry. Start reading this because it is a very important question. This question has a linkage in 3 chapters. First is exemption, because it is talking about exemption under 1010D. Then it is also having linkage in the chapter of other sources, because if it becomes taxable, it is taxable in the other sources. And third, it has a linkage with deductions, because we take deduction of life insurance premium in chapter 680C. So you can treat this as question of other sources also, of exemption also, of deduction also. So since I did not take this type of question in other sources purposefully, I'm taking it here, so that somewhere at least this question is getting covered. Yes, students. Go through the question. Sarva, is this capital gain or is it PGBP? And within PGBP, will it be, what do I say, a speculative business or regular business? Yes, students, now for your benefit, I'll just open the respective chapter in case you're not able to recall the provisions. 1 second. Okay, I'll do one thing. I'll open it from other sources. It will be much easier. Yes. So just to give you a brief, so there is this exemption under 1010D. What it says, any sum received under life insurance policy. So whenever your life insurance policy is getting matured, including the sum allocated by way of bonus of such policy, would not be included in the total income of the person. So this is the point from exemption chapter. So as per 1010D, life insurance policy amount, whenever it gets matured, will not be taxed. However, there is exception to this. What is the exception? So for this table will help us understand. So there are few due dates or the timelines. Now these timelines are the same which you have studied in chapter 6A deduction, because whenever you make payment of premium for life insurance policies, and if you have opted out of the default regime, that is if you are in the old tax system, you are given deduction under chapter 6A section 80C. Correct, students? That is for the premium paid for the life insurance policies. So first is you are paying premium, which is falling under chapter 6A, but this is only under the old scheme, not under the new scheme, that is a default scheme. First point. Second point, this particular amount of deduction, if you recall chapter 6A, so we are now revising chapter 6A also, is connected with the dates. So first, if the policy is taken before 1st April 2003, there is no restriction condition. If the policy is taken between 1st April 2003 to 31st March 2012, your premium should not exceed 20% of the sum assured. If the policy is taken after 2012-13, now this is for people who are physically or mentally challenged. So for them, it is 10%. And in respect of policies issued after 2013, that is for people who are physically challenged, it is 15%. So in simple words, if you recall this provision, for us, this part is more relevant for Chapter 6A deductions, that whenever you are making payment for life insurance premium, you have to ensure that if the policy is taken before 1st April 2012, premium up to 20% will be allowed. If the policy is taken after 1st April 2012, then the premium up to 10% of your policy amount, which is the capital sum assured means policy amount, will be allowed. Now, if you recall this point from deduction chapter, now coming to other sources chapter, what does other sources chapter say? So other sources chapter say that on similar lines, we will determine the taxability whenever you will receive this amount. Now, what is the taxability? So first rule is under 1010D, amount received at the time of maturity of life insurance policy should be exempt. But now this has this condition or qualification. If the policy was issued before 1st April 2003, where there was no limit for the purpose of deduction chapter also, then in all cases, the amount received will be exempt. However, if the policy was issued after 2003 up to 2012, so you have to recall that in deduction chapter, the limit on deduction was up to 20% of sum assured. Now, same condition applies in exemption. What it says, any sum received under the life insurance policy, including sum allocated by way of bonus, is exempt. However, exemption would not be available if the premium payable in any of the years has exceeded 20%. So in simple words, if you are not eligible for deduction under chapter 6A, why? Because your premium exceeded the specified limit. So in similar case, you will not be eligible for exemption when the policy amount is received. Same condition is here. If the policy was issued after 1st April 2012, then exemption would not be available if the premium in any of the years during the life or the term of the policy has exceeded 10% of the sum assured. So simple, your deduction under chapter 6A, the restriction over there also is continued in exemption. So wherever your policy's premium exceeded 20%, you are not allowed deduction. You are allowed deduction only up to 20%. And where it exceeded 10%, you are allowed deduction only up to 10%. So wherever those amounts were exceeded, deduction also was not fully allowed. And in such cases, when such policies will get matured, you will not get any exemption under 1010D. The only exception to this is if the policy is not matured, but it is given to you because of death. So only at the time of death, if you are receiving the policy, then only it will be exempt. Otherwise, it will not be exempt if your premium had exceeded the 20% or the 10% limit. This is the first rule. Now, coming to a new condition, that is in respect of policies issued on or after 1st April 2023. Now, when we are talking about this particular policy, again, the limit for the purpose of deduction is 10% because these all policies are definitely after 1st April 2012 because they are issued on or after 1st April 2023. Now, what is the rule? Again, first rule of exemption is all sum received under this policy will be exempt. However, exemption will not be available. Firstly, the same condition if the premium has exceeded 10% or 15%, 15% in case the person is physically challenged, then you will not be getting the exemption if the premium of any year has exceeded this 10% or 15%. Now, besides this, if the policy is on or after 1st April 2023, an additional condition has been put. What is the condition? Now, see, the same condition is even in deduction, the same condition is here. Further exemption would not be available if the amount of premium exceeds 5 lakhs for any of the year during the term of the policy. So additional condition put is, so now you have to satisfy two conditions. Percentage wise, the premium is not exceeding 10% and amount wise, the premium is not exceeding 5 lakhs. Now here a question came, or what people started doing was they started making policies by making two, three policies. So they, instead of having one large policy of 10 crores where the premium exceeds 5 lakhs, they will make the policy small policies where each policy premium is below 5 lakhs. So for that, the other provision that is added is in case where the premium is payable by a person for more than one policy, correct? Then while deciding this 5 lakh limit, the aggregate of the premium payable on such policies will be considered. And if the aggregate premium of such policy has exceeded 5 lakhs during any of the previous year during the term of the policy, now what will happen? Now exemption would be available only in respect of any of those policies at the option of the assessee whose aggregate premium does not exceed 5 lakhs for any of the previous year. In other words, if you have multiple policies, we will not give you exemption for all the policies because all the policies taken together has exceeded 5 lakhs. Then you will be given the choice out of these multiple policies, which policies you want to take the exemption. Correct? Now, if you have understood the provision, let us come back to the question. Now, Vivek has taken a life insurance policy A on this date. Now, please mark the dates are very important. So this date is falling after 1st April 23. So now two conditions have to be checked, 10% also and 5 lakhs also. Another policy B, which is also taken after this date, both are of 10 years. Sum assured is 35 lakhs, 25 lakhs respectively. Annual premium payable is 3.5, 2.5. Now important. Independently, the premium is not exceeding 10% that you have to check. Second, independently, the premium should not exceed 5 lakhs. If collectively it is exceeding, it is okay. What will happen, we'll see. So apply one thing at a time. So firstly, independently, are the premiums exceeding 10%? For 35 lakhs, it is 3.5 lakhs, not exceeding. For 25 lakhs, it is 2.5 lakhs, not exceeding. So firstly, both the policies are satisfying our 10% condition. Now, are they satisfying the 5 lakh rules? Answer is yes. Independently, none of the premium is exceeding 5 lakhs. Now, what would have happened if independently one of the premium is exceeding 5 lakh? We are just checking so that entire provision can be revised through this one example. So let us say this policy's premium is exceeding 5 lakhs. Let us say it is 5.5 lakhs for the time being. Now, again, test the condition. 10% is it satisfied? No. Or let us say, for example, I am changing the policy figure also. 10% is satisfied, but since it is exceeding 5 lakhs, in that case, policy A would have been taxable always. So what I mean to say, wherever the premium exceeds 10% or the premium exceeds 5 lakhs in any of the years, then that policy will be taxable. The exemption under 1010D is gone. Now coming to the point of present situation. Now presently both policy premiums are up to 10%, not exceeding 10, and independently they are not exceeding 5. But if you add both the premiums, the premium of both the policy together is exceeding 5. Now whenever this will happen, the present point which we were discussing in the topic will be applicable. Now what is given? In 33-34, Mr. Vivek received the maturity proceeds from both the policies. One is 40, one is 27, respectively. Considering the most beneficial to Mr. A, which of the following statements is correct? Now see, the point is, in such cases, wherever the collective premium has exceeded 5 lakhs, now the law says, I will not give you exemption for both. I will give you exemption for only one. Which one that you decide? Now, if this is clear, check which one you will opt for because both I will not give because the collective premium is exceeding 5. Had the collective premium of both together not exceeded 5, I would have given both because up to 5 lakhs, I'm okay. But your premium collectively is exceeding 5 lakhs. So I'll give you exemption for anyone. Now it is your choice which exemption you will take. So think logically. Policy A will give you 40 lakhs, policy B will give you 27 lakhs. So logically, you will take which exemption? Obviously, I'll take exemption of A and I will make B taxable. This is the most beneficial position. Now, once you have understood this, now analyze the answers. The maturity proceeds from both A and B is exempt. This is incorrect. Second, the maturity proceeds from A is exempt but B is taxable. Maturity proceeds from B is exempt, A is taxable, and maturity proceeds from both A and B is taxable. Now, I'm sure you are in the best position to give the right answer. Good. Vishakha, Dhanlakshmi, Gayatri. Yes, Harshal, correct. Amar, good. Now, students, which one is the correct answer? Correct answer is option B. Correct? I hope now it is clear. Any doubts now? Why D, Anchal? Answer should be this, no, not D, na? Because D says majority of both is taxable, but that is not correct. I can take exemption of one because independently none of them have exceeded 10% and none of them have exceeded 5 lakhs independently. So definitely independently they are eligible for the exemption, though not collectively. I hope this is clear, students. Now, if you want, you can take a screenshot of this second question, which we are now going to discuss and solve. This will require some solving. So this is relating to set off. Harshal, if independently they are exceeding 5 lakhs, then whichever is exceeding 5 lakhs will be taxable. So if independently A is also exceeding 5 lakhs, B is also exceeding 5 lakhs, then answer D or the option D will come into picture. But here independently, none of them is exceeding 5 lakhs. So the correct answer is B. B for Bombay. Correct, Harshal? Chalo. If you all have taken the screenshot, let us deal with this. Now in this question, I've tried to cover set off chapter plus clubbing chapter both. Should we start? So you can use the screenshot at your end. So even though now the entire question is not visible on your screen, but at your end, you can open the question in the screenshot that you would have taken. And from there, you can navigate as per your convenience. So I'm reading here. So K is 48-year-old, so not a senior citizen. Details of the income for this year is as under. Now he has two businesses, a regular business and a speculative business. Speculative has a loss. Now, when you see this, something should trigger to your mind because for speculative, there is some restriction in set off, correct? Now, he incurred a loss of 215 from a let out property and earned an income of 50,000 from activity of owning, maintaining race horses. So you have to also keep in mind the classification as to which head these incomes belong to. Further, for earning this income of activity, he has also spent rupees 5,000 as expense. Okay. Further, he has earned short-term capital gain 50,000 from equity shares sold on this date on which STT is paid and long-term loss of this from other assets sold. So short-term gain, long-term loss. Again, you have to check whether set-off is allowed. Mr. K took divorce from his wife on this date and the custody of their minor son is given to Mrs. K. Now, this is relating to clubbing, right? Following the divorce, he transferred ownership of house to the wife. So he has given the property free to his wife, correct? And during the financial year, this property has generated income of 5 lakhs. So you'll have to test whether this has to be clubbed with Mr. K because K has given this property free to his wife. Further, K deposits cash of 50,000 every month into the bank of his minor son. During the year, interest of 25,000 is generated. Again, you have to check whether this can be clubbed. Next. K also contributed a sum of 2 lakhs to electoral trust. So even deduction is covered in this. So this question you can say is covering everything of today's revision topic. So this is about electoral trust. 30,000 is on advertisement in a brochure of political party. Then he authored an investment portfolio book and received royalty of rupees 410 during the year from a publisher in Germany. The royalty is calculated at the rate of 16%. So again, this income is part of other sources. Plus also it has something in deduction. So you have to even test the deduction topic. He incurred 60,000 as expenditure for earning this income. Now out of the total royalty, that is 410, what he could get within India within the time limit, which is end of September, is only 290. So this affects the deduction part, right? Now compute the total income of K, assuming that he has exercised the option of shifting out. So why shifting out? Because deductions are available only in shifting out. Had he continued in the default regime, that is the new regime, he would not have been allowed deduction of these. Only two deductions are allowed, or rather, sorry, three deductions are allowed in the new scheme, nothing else. Fine. So students, you may also parallelly start solving. So I will say computation of total income. Now see here, we are not asked to compute tax liability. So that will be outside. Mr. K, AY 26, 27. Fine. So first is income from salary. So there is nothing for salary head. Income from HP. Now in this, hmm, now see, you are having one, which is the HP loss of a let out property. Two, you have given one of the properties to your spouse. You have given one of the properties to your spouse, and on that there is income of 5 lakhs. So we have to first test whether it is to be clubbed. So just for your revision, I'm taking you to the clubbing provision. What does clubbing provision says? See, income arising, no, not this one. Income arising to spouse from asset transferred without adequate consideration. So you have transferred your house property to your spouse. This is done without consideration or without adequate consideration. Here it is without consideration, you have given free. Now the first rule is that income arising from such asset has to be clubbed, which is transferred otherwise than for adequate consideration or not in connection with an agreement to live apart from one spouse to another shall be clubbed in the total income of the transferor. However, this provision will not apply in case of transfer of house property, since transferor spouse will be deemed to be owner as per section 27. Now, similar clubbing provisions for house property income are under 27. Now, I'm not taking you to 27 because it will be again going to another chapter, but over there, same provision exists that whenever you are transferring your house property to your spouse without consideration, the income arising from such house property has to be clubbed. Same like this point. However, over there also under section 27, same exception is given that when clubbing will not be applicable. So clubbing will not be applicable wherever. So this transfer has happened in connection with an agreement to live apart. So this is what we call as divorce. So whenever there is a divorce and in connection with the divorce, you have to give a property to your spouse as an alimony or as per court's order, then such a property given to spouse because of the divorce is not to be clubbed. Even for house property under section 27, same exception applies. So yes, very good. So you have rightly identified Garva, Dhanalakshmi. No, Garva, at the time of giving, she was a spouse. So that is why this question comes, correct? So before the entire divorce is done through, you have to first give away the property. So even as per the question, if you read the question, Garva, they have clearly said that you had given this to the spouse. So means at the time of giving away, she was spouse, but then you divorce. But this was given as a part or because of the reason of divorce. Correct. So we will not club this income. So this income will remain taxable in the hands of Mrs. K. Correct? So now see, even if you are doing not doing something, you have to still mention it. So HP transferred to Mrs. K. I am writing not applicable. You can also write nil. But why? You have to give a note. So working notes 1. Since HP is transferred to spouse in connection with agreement to live apart. Hence, the income arising from such HP cannot be club. References section 27. Fine. So simple. See, many times students are confused and they ask me, sir, we don't understand how to write notes. See, there is no standardized method or rule for writing notes. You have to simply write it in your simple language by explaining the provision. So whatever you have done, you have not considered it here, you have not subtracted it here, you have not added it here. Whatever you have done, simply write it in your simple words. Correct? And wherever possible, give the reference of the relevant section number. This is the only requirement. Fine, students. Now, besides this, you have another property for which you have incurred a loss. Now, what will happen? It is 2,15,000. Now, this is your HP, so it has to be considered in your computation. What is the treatment, students? Anything special in this? Good, Gayatri. Yes, Anchal, correct. Good, Dhanalakshmi. Yes, good, Vishakha. Yes, others. So, as rightly pointed out, in case of house property loss, there is a provision under section 71 bracket 3A. So, I will write a note. As per section 71 bracket 3A, loss from HP can be set off against other head up to maximum rupees 2 lakhs. Now we have 215, so hence balance to be carried forward to next assessment year. How much is this balance? Rupees 15,000. Correct? Now, third head is income from business and profession. We have only two businesses, manufacturing, speculative. Now, what is the provision, students? Manufacturing, speculative. Now, one has income, one has a loss. Any specific provisions that you have to keep in mind over here relating to set off? Very good, Vishakha. Correct, Dhanlakshmi. Correct, Garva. So, Anchal, what you want to say? PGBP is correct. So, we are under the PGBP head. Now, my question is one is income, one is loss. So, what has to be done for both these? Amar beta, wait, we are not yet on capital. So, don't mix. Talk headwise so that even while solving, you are not confused. Right now, we don't have to see any other head, only one head. Correct, Simran. No, Anchal. So, the correct provision student says that speculative business, if it has a loss, it cannot be set off against other incomes. It can be set off only against another speculative business. So, if you have had two speculative businesses and the other speculative business would have had a loss, you could have set off this loss over there. But you are not having another speculative business. So, this loss cannot be set off either from the manufacturing business or from any other head. So, you have to carry forward that particular loss. Now, can anybody tell me if I carry forward this, what is the time limit for setting off the speculative loss? Harshal, you are right, beta. Very good. Garva, Gayatri, Harshal, Vishakha, Amar, you all are correct. Dhanlakshmi is not correct. What you are saying, Dhanlakshmi, is applicable if it would have been a 35 AD business. Correct? Yes. So the answer, students, is 4 years, as rightly pointed out by many. So here I will write as per section 71, read with section 73. Speculative business loss can be set off only against another speculative business income. Hence, the entire loss of rupees, how much is it? 7 lakhs has to be carried forward. You can add just for the reference up to 4 years. Correct? Now, the other business is a normal business where you have a profit of 10 lakhs. Now, I have to still set off this loss. So, I'm leaving 2 lines blank and we proceed. Now, you'll ask, sir, why you are leaving 2 lines blank? So that in case if I have to, in case if I have to set it off against business income, I'll show it here. Correct? But before that, let me check what are the other incomes which I'm having. Can I set off this against any other income? Let us check. So this is done. Now we are here. So there is a short-term capital gain of 50,000, long-term capital loss of 75,000. Now here, what is a provision relating to capital losses? So Vishaka, in this case, what will happen, beta? Very good. Yes. Correct, Anshul. Yes, Dhanlakshmi. Yes, correct. Vishakha. Okay, good, Harshal. So, students, you all are correct. Short-term loss, had it been, it could have been set off against long-term gain. But since this is a long-term loss, it cannot be set off against short-term gain. So there is a restriction on setting off long-term loss. So long-term cannot be set off against short-term. So short-term capital gain, long-term capital loss, again not applicable. Note 4, 70. Hence, the entire loss of rupees, how much it is? 75,000 shall be carried forward under section 74 up to how many years, students? What is the time period up to which you can carry forward this loss? Yes, very good. Vishakha, Gayatri, Dhanlakshmi, Amar, Harshal, Lavanya, Arun, Garva. Very good. It is 8 years. Good. Now again, I'll leave a line blank because I have to still set off my HP loss and I have to check whether I should set it off against my business head or I have to set it off against my capital head. Let's see. So we proceed with the other heads. So this is also done now. So there is a deposit on which there is an interest income. Now what about this interest income? This is earned by your son, minor son. Now the rule is minor's income has to be clubbed with the income of parent. In this case, what you will do? Very good, Dhanlakshmi. Very good, Amar. So Arun, what is the answer? You are only giving section number. I want answer. Correct, Vishakha. Correct, Dhanlakshmi. So the answer is clubbing is not applicable. Why? Again, let me take you to the clubbing chapter. So for minor child income, the first rule is income of minor child shall be clubbed with the income of the parent. Now, which parent? That parent whose independent income is higher. So whichever parent's income is higher, mom or dad, in that parent you will club. However, there is exception. What is the exception? If the marriage of the parent does not subsist, which has happened in this case, that is, there is a divorce. Now, in such cases, the income of the minor will be includable in the income of that parent who maintains the child. So, whenever there is divorce, then the rule of higher income parent is not applicable. It will be clubbed only with that parent whose individual income is higher. Arun beta, what is ATU here doing? Where is ATU required here? Now, since in this question, the child's maintenance is with mother, correct na? See, somewhere it was written. We read na somewhere. Huh. The custody of the minor is given to Mrs. K. So since it is with mother, hence clubbing is not applicable in Mr. K. So this amount of interest will not be taxed to Mr. K because it will be clubbed with mother's income. Yes, Ketan, I have unmuted you. Ketan? Simran, if minor child's income would have been clubbed here, if that is not happening because of this exception, but had it been clubbed, then you are correct. There is an exemption which gives you exemption of rupees 1500 under section 10 bracket 34. So you would have taken exemption of 1500 rupees, Simran, had it been clubbed. Sorry, 1032. Thank you, Arun. Not 1034, 1032. Yes, Garva.
Sir, I didn't get point for the
Your voice is not audible. Garva, Garva, please be louder.
Sir, I didn't get the income from house property point. Says following the divorce. So shouldn't it mean that it is after the divorce? So it should mean that she's not even a spouse.
See, understand one thing, Garva. If you have transferred anything to her after the divorce, anyways, the clubbing provision will not be checked itself
Hmm.
because
Yes,
you're transferring it to her after after she's not your spouse.
exactly,
The clubbing itself does not have to be checked.
exactly.
Following the divorce means because of the divorce. See, in English, multiple cases you'll find a single word having different meanings. So here the word following the divorce does not mean after the divorce. It means because of the divorce or on account of the divorce. Correct? Is this clear, Garba? Yes, correct, Anshul. So here, Harshal, there is no need of exemption because the clubbing itself of 20,000 is not happening with Mr. K. In Mrs. K, where you will club this 25,000, over there you will take the deduction of 1,500, Harshal. So interest of minor child, again not applicable. So since custody of minor child is with Mrs. K, hence interest will be clubbed in Mrs. K's income and not Mr. K. Section 64(1). Correct? So see students, in this question we have set off, we have clubbing. We also have deductions, but they are yet to come. We'll first complete this. So this is point of deduction. We'll see later. Now we have royalty of 410 and you have incurred expenses of 60. So this is one of your other sources income. So it is received for 10 minus expenses incurred is 60. So how much is left? 350. Correct? This remaining part will be required when we are going to deductions part. Now, huh, any other income left, students? There was something, yes, activity. So he has earned 50,000 from activity of maintaining resources. Expenses incurred is 5,000. Correct? So 50 minus 5. 50 5, no? Okay. Now, so these are all our income, students. Now, please understand, we are yet to set off this loss, which is allowed up to 2 lakhs. We have already written the note. But the question is 2 lakhs against which income? Now I have three incomes. One is PGBP, one is this capital gain, and then you have other sources. Now, firstly, listen to my question. This 2 lakhs HP loss, can it be set off against short-term capital gain? And let me tell you, it is under 111A because STT is paid. So can it be set off against this income of short-term capital gain? Gayatri, I didn't get what you are saying, net related. Okay. Harshal, my question is whether this HP loss, which we have already written a note, can be set off up to 2 lakhs. So remaining 15,000 we are already carrying forward. This 2 lakhs, can I set it off against short-term capital gain? Anshal, question is, I have a loss to be set off of HP 2 lakhs. I have three incomes. One is manufacturing business, which is a regular business income. One is capital gain under 111A. And I have two incomes under other sources. Now, first I'm asking, can I set it off against short term under 111A? Yes or no is the answer. Obviously, Harshal, to the extent of income. So the answer is yes. There is no restriction on the gain. Why, Amar? Why you cannot set off HP loss against STCG? Where is the restriction? Whoever says no, where is the restriction? Please tell me. Even Gayatri, Lavanya, Garv, Simran, you all have said no. Amar. So my question is no, because of which provision? Tell me. Where is the restriction? Tell me the section number. Yes, students, where is the restriction? Now, I'll tell you what restriction you may be thinking of. The first restriction is that there is a restriction on long-term capital loss, that it can be set off only against long-term gain, that we have already done in this question. Then under section 71, there is one more restriction. The restriction is this, which means any loss under the head capital gain, be it short-term loss, be it long-term loss, both these losses cannot be set off against any other head income. So if you have a long-term loss, anyways, we already saw the restriction in 75, it can be set off only against long-term. It cannot be set off against any other income. If let us say you have short-term capital loss, short-term can be set off against short-term gain, long-term gain, both. But if you have short-term loss, It cannot be set off against salary, HP, and other heads. But that is the restriction on losses under the capital gain. Is there a restriction that if there is a loss under any other head, that cannot be set off against capital gain? The answer is no. Now we talk about particularly HP loss. So for HP loss, there is no restriction given here that HP loss cannot be set off against capital gain. What it says, the loss under the head HP would not be allowable to be set off against income under the other heads if you are under the concession rate. So if you are under the concession rate, no set off completely. But if assessee exercises the option of shifting out of the default regime and there is a loss under the head HP, then the assessee can set off the loss up to maximum 2 lakhs. Now this can be set off against any head income. There is no restriction. So 2 points. Loss of capital head has restriction, but gain of capital head has no restriction. So this point number 3 does not put restriction. And even under the HP category, because now we have to set off the HP loss, there is no restriction that HP loss cannot be set off against capital. In short, the final answer is that HP loss can be set off against short term. Please don't get confused, students. The restriction is on loss. That is, capital loss cannot be set off against other heads. There is no restriction that other head losses cannot be set off against capital gain. Please be clear. So Harshal, the note is on long-term loss. Now we are talking about short-term gain. So that is why I'm asking particularly. Can you set off HP loss against short-term gain? I've showed you the provision, both. For capital also, there is a restriction which is on the loss. And for HP, there is no restriction at all. So then, can HP loss be set off against short-term capital gain? Yes, Harshal. Now what is your answer? Good. So now I'm sure you'll understand and it is clear. So in case this was a doubt because of this question, that doubt is also clear that you can set off HP loss against short-term gain. You can. Now the question is whether I should. Now what will decide that whether I should or not? It will be decided by the tax rates. If you remember, there are special rates for short-term 111A and long-term. For short-term 111A, the rate is 15. So if I set off any loss here, my tax at the rate of 15% is saved. Please keep this in mind. Now, what if I set off against business? Now, business does not have a special rate, so it falls in slab. Similarly, my royalty, my activity of maintaining resources, all these are under the slab rate. Now, what is my total of slab rate income? It is 10 plus 3.5 plus 45. So it is 13,95,000. Keep this in mind. Now, this 1395 will be taxed as per slabs. Now, if you recall slabs, and also remember we are in the old scheme. As per the slabs, your income, since it is 13.95 lakhs, has crossed the 10% category. Sorry, the 5% category. And after 5% category, you immediately have the 20% category. So your income is already in the 20% category, which means my short-term gain, which is at 15% category, I have that option. And second, my other incomes, which has now gone into the 20% category, I have this option. Now, logically, you should set off against which income? 15% rate income or the income which has gone to higher slab, that is 20%. Logically, 20%. It means either I should set it off here because whatever I set off will go to reduce my regular income, or you can set it off here wherever you feel like. You can show the set off. So I'm showing the set off here. HP loss, which is up to 2 lakhs. As we all know, we have already written the note. Again, the same note number 2 is repeated. So here, nothing is there in the outer column. Here 8 lakhs is there after setting off the 2 lakhs of HP. Here I have not done the set off because this 50,000 is already taxed at a lower rate. Here I could have set off, but I have not set off, though you could have, because this is also falling in the slab rate. So you can avoid this because you have already set it off against business income, which is falling in the same slab rate. So now I get GTI. So it is 8 lakhs plus 311, 1245. Students, I hope this point of deciding where to set off is clear. Arun, this is not long-term gain. So here it won't be 12.5. This is short-term gain. So you'll not compare it with 12.5. You have to compare it with 15. Short-term triple one is not 12.5. Students, I hope this is understood by all. Up to this point, everything clear, no doubts. Now, had you been under the new scheme, that is a default regime, I would not have required to do anything in deduction. But since we have opted for the old regime, that is, we have opted out of the default scheme, hence now you have to test your deductions also. Now, what are my deductions related pointers? It is this. So you have contributed 2 lakhs to the electoral trust and you have contributed 30,000 to the brochure of political party, plus whatever you have received. Where is it gone? Royalty. So whatever you have received on account of royalty, yeah, this one. This also has deduction under chapter 6A. So let us go one by one. So first, section 80 GGC, which is for donation to political party, right? 2 lakhs. Now here again I have to write a note, which is my running note number 6. No deduction under section 80 GGC is allowed for what? For expenses incurred. What was that? On advertisement in brochure. In brochure of political party. Correct, students? Now comes the other deduction, which is under section 80 QQB, which is for royalty. Now this will again require some working. Calculation of deduction under section 80 QQB. Now see, for 80 QQB, the limit is 3 lakhs of deduction, but that 3 lakhs has to be compared with your royalty amount. But which royalty? Royalty received in India. So you may have earned a higher amount of royalty, which is 410, but what is received by you is only 290 up to the time allocated. So what is eligible is 290. but you have already incurred some expenses, 60,000. So the net which is eligible is 230. Now this is to be compared with maximum limit. Now what is the maximum limit? One is royalty at the rate of 15% and the other is maximum amount. Maximum amount is 3 lakh rupees. Royalty at the rate of 15%. Now, how much royalty we received? We received 410, which is at the rate of 16%, correct? So, 410, correct? This is at the rate of 16. So, how much will be at the rate of 15? So, 410 divided by 16 multiplied by 15. So, one limit is royalty up to 15% is allowed. Second, up to 3 lakhs is allowed compared with the actual royalty, which is the net royalty. So calculate how much it comes. Gayatri has said 384,375. Vishaka is giving the same figure. So I'm putting down this figure 384. Now out of these three figures, which is the lowest, 230. So the deduction which I will claim is 230. So I'll get taxable income 4815. So this is the final answer, students. See if you have any doubts in any of the pointers. Let me know. Yes, students. Anybody, any questions? Why, beta? Why political party deduction is not allowed? We have 80 GGB, GGC, both allowing you deduction for political parties. See, Arun, I have unmuted you, beta.
Yes, sir. Sir, actually, I confused about tax rate. You just mentioned a 111A, a tax rate is 15%, but it 20%, right?
Which years we are doing? Oh, correct. You're right. It is now 20%. Correct.
Okay, thank
You're
you.
right, beta. Now it has been increased to 20% because the transaction is post July 2024. You're right. Somebody was asking about political party. See, GGB, GGC, contribution to political parties condition is it should not be in cash. Second, contribution to political parties. So there are two sections where if a company is giving you apply GGB, if a non-company is giving you apply GGC, so the donation can be to political parties or to electoral trust. So here we have given to electoral trust. So hence it is eligible. Correct? Fine, Vishaka. No. Understood, all students? Everybody clear with this? No questions, no doubts. Should I proceed? Chalo. Moving on. Shall we read this? Or we'll just skip this. This is a very small question, one-line question. Only one question is there. Let us take this. This is slightly lengthier. So we'll solve the lengthier questions first, then we'll go to the smaller one, so that we cover those questions having majority of adjustments in one question. So let us take up question 4. You can take a screenshot. 1 second. Yes, 1 second. Is the entire question visible? Yes. Students, take a screenshot of this. Let us solve this question now. Screenshot done. So again, students, this question covers all the 3 topics that we are discussing, right? So let us read. So Akshay, a resident individual, provides following details for the year ended 31st March 26. So he has salary, rent received from house property which is situated in Delhi, repayment of loan taken for above. Now, whenever loan repayment comes, you have to check 2 things. One is interest, which will be allowed under HP head. The other is principal, which could be allowed under Chapter 6A depending upon satisfaction of conditions. Next, rent received from house property in Jaipur. Again, there is an interest on loan taken for repair of house property situated in Mumbai and Delhi. Okay. So this interest is for 2 house properties combined. The property in Mumbai is self-occupied. Okay. Loan was taken on this date and was utilized 50-50. Fine. Long-term capital gain on sale of equity shares is this. Interest on fixed deposit is this. Loss from textile business is this. Speculation business profit is this. Lottery income gross. Loss incurred by the firm in which he is a partner. Salary received as fine. Life insurance premium paid for his son. Okay. And you have brought forward losses of previous year. Compute total income of Mr. Akshay and the amount of loss. Mr. Akshay has opted out of the new regime. So deductions are eligible because he has opted out. Fine. This is question number 4. Taxpayer Akshay. Okay. Now income from salary given is gross or net computed. So it means standard deduction is done. I can directly take the amount in the outer column. Had this not been the case, had it been salary received, I should have deducted the standard deduction. Until I have uploaded the notes of capital gain before the class. In fact, these notes are also uploaded. You have not yet received capital gain notes, Anshul. Questions have already been uploaded the same day. In fact, it was uploaded before the class. And today's questions are also uploaded before the class. Acha, we are saying no. So I'll check with the technical team and I'll revert back to you. Now you have 3 properties. One is in Delhi, one is in Jaipur, and one is in Mumbai. Mumbai is self-occupied. Other 2 are let out. Correct? So you have the Delhi property. You have the Jaipur property. You have the Mumbai property. So working out what? Okay, students. So now let us start. GAV under section 23. Rent received from Delhi is 5 lakhs, and there is nothing given about expected rent. So by default, this will be your GAV. Rent received from Jaipur is 320. Again, this will be GAV. And Mumbai is self-occupied, so it will be nil. Correct? 5, 320 and nil. Minus. Municipal tax paid. I suppose municipal tax is not given for any of these. So you get NAV minus standard deduction at the rate of 30%. So this is 150. 3 2s are 6, 3 3s are 9. So this will be 96, correct? Minus interest on borrowed capital. Now, this repayment includes interest of 7 lakhs. And here this is interest. You have to do 50-50. Correct, students? So here in one case, the interest is 7 lakhs. In other case, it is 75. In third case, it is 75. Now, can I deduct entire 7 lakhs? Is it allowed? Or is there a limit? Yes, students. Is it allowed or is there a limit? Harshal says limit, Gayatri says fully allowed. What about others? Amar, don't go on repairs. Right now, I'm on the first interest on 7 lakhs. So how much if you are saying, Anil, what is the amount? I'm asking for 7 lakh students. Be specific to the question because whatever answers many of you are giving are vague. So I'm not getting whether you're talking about this interest or the other 75,000 interest. I'm not getting. So can I take 7 lakhs or there is a limit? If you say there is a limit, what is the limit? Students, this is where you have to read the law precisely. The limit of 2 lakhs, which many of you are suggesting, is only where the property is self-occupied. Here in this case, our property is not self-occupied. Property 1, property 2, both are let out properties. Since the properties are let out, there is no limit. So first loan is taken for purchase, and since it is let out, please be clear, no limit. Correct? Now next, interest for repairs of house property Mumbai, Delhi. And it is 75,000. So Gayatri, why so? So second interest is on loan taken for repairs. Here 75 and here 30. Now here also the amount should have been 75, but here the limit applies because the property is let out. Now property is self-occupied. Now within self-occupied, there are two limits, 2 lakhs and 30,000. 2 lakhs is applicable where the loan is taken for either purchase or construction. Here, since the loan is taken for repairs, hence the limit applicable is 30,000. So this is your final HP income computation. So 7, 8, 9, 25. So this is 425 loss. Correct? 96, so it is 100, so 220, 224. And this is again a loss of 30. Correct? So in my inner column, Delhi, I am showing as loss. This I am showing as income. This again I am showing as loss. Is this understood, students? Students, any questions up to this point? Now, these losses I'll first set off against this income to the maximum extent possible. After I do that, what is left with me is a net loss of 231. This loss I have to set off against other head incomes, right? Now, for the time being, I have salary. So I'll just wait and complete my sum to find out if I have other heads income and to what extent I have those incomes. Correct? And then I will decide what to do. Arshal beta, you are again mixing. Interest is allowed fully. Why? Because the property is let out. Once the property is let out, the loan can be for purchase, for repairs, for renovation, for construction. Interest is allowed full because the property is let out. Had the property been self-occupied, I would have limited my interest as we have done in case of Mumbai property. I hope I am clear. Harshal. Great. Should we proceed now? Should I go to the next head, which is PGBP? Now this is done, this is done. Here only one thing is left, that is principal on housing loan. That is given, that we'll have to see at the time of deduction. Now this is capital. Now I have PGBP. First is loss from textile, speculation profit. These are again PGBP items, correct? Because as a partner, whatever I receive from the firm goes to PGBP. So let me start profit to 30. Correct? Then I have textile business, which if I'm not wrong is a loss. Yes, it is a loss 750. Now my first question, can I set off a regular business loss against speculation business income? In the previous question, we have not done it. Now here, can a regular loss be set off against speculation profit? Yes, good. Anchal, Simran, why no? Barna, Amar, Harshal, Vijay, why no? Again, students, please remember, restriction is on speculation business loss, not speculation business income. Please be clear. Speculation loss cannot be set off against other incomes, but other losses can be set off against speculation business income. So here, this set off is allowed. Understood? Next, loss incurred by the firm in which you are a partner, 160, and salary received 50. Share in loss. Not applicable. With salary from partner. In partnership firm is exempt in the hands of the partner. Section 10 bracket 2A. So whatever share you receive, whether profit or loss, it is exempt. So both have not to be considered. Okay? Now, this is business head. What is your position? So 470 is my loss. Is this correct, students? Yes, students, is this correct? 470 is my loss. Great. Now I'll have to check where I can set off this. Income from capital gain. Now I have long-term gain, 795. There are brought forward losses. Okay. So for this, I have brought forward losses. So I'll have to check whether I can set it off. Now, current year, I have long-term capital gain on which STT is paid. So it is under 112A, correct? Na? 795. So LTCG under section 112A. minus brought forward short-term capital loss on sale of gold and loss on sale of equity shares under 111. So there are two short-term losses which are brought forward. Can I set off both these losses? One is a regular short-term loss, one is 111A short-term capital loss. Are these short-term losses, both or any one of them, set offable against long-term gain? Or I cannot set off both. So brought forward short-term capital loss, both 275 plus 25, 3 lakhs. Both are set offable. 1 second, I will not write it here. I don't know whether I have to set off the capital, not capital, sorry, business loss I have, correct? We will have to still check if I can set off the business loss anywhere. Now, other sources. What do I have, students, in other sources? Yes, very good. One is lottery income 75 and one is interest on FD 73. Lottery income. And FD 70. Correct. Now I have put down all the incomes. Now I have two losses to be set off. One is HP loss, one is business loss. Now, students, same logic. You have to see the tax rates of the income. So you have salary income, which is slab rate, and definitely this is going in 30% slab. Plus you have capital gain, which is under 112A. So this is 12.5%, right? Plus you have again lottery income, which is 30%. And you have interest on FD, which is going in slab rate, which is again 30%. So definitely logically, I should prefer first what? I should prefer the slabs of 30%. Now, when I come to business loss, I have 470 business loss. I have huge amount of salary income, but the problem is I cannot set off this loss against salary. So textile business loss cannot be set off against salary or even one more income, that is this. I'm sure you all know that all these incomes, which are special incomes, or this lottery, betting, gambling, set off is not allowed. So business loss cannot be set off against the two. So for this business loss of 470, even though this is a lower rate income, students, please remember, I will have to use it. I have no choice. Yes. But before that, I will subtract the textile business loss from this, because that I can do, correct? This 75 will be outer column. What is this 75? This 75 is my lottery income. So this 73 is gone. So textile business loss I've adjusted here. Now, what is the textile business loss which I can set off here? Textile business loss. My original loss was 470 minus I've already adjusted 73. Correct? So 396, 397 is left. So remember, students, my preference is not this income to set off. Why? Because it is a lower rate income. The rate is only 12.5. But I have no choice. So I'll have to use it here because business loss cannot be set off against salary. So I'm using it here. Correct? So what is the amount? 495, 397, 98. So my final capital gain is 98. Now this 470, this 2 lakhs out of this note number 4. HP loss can be set off to maximum rupees 2 lakhs against other head incomes. What is the section, students? What is the section for this? 71 3A. Correct? Clear, student? Now I'm writing it here so that it gets adjusted against the head salary. So now what is the position? 3520 minus 2 lakhs. So it is 3320. 3320. 3418. And 3418 plus this is 3493. Is this correct, students? GTI. Deductions under chapter 6A. Now here, what do I have for deductions under chapter 6A? See here, there is a principal on housing loan repayment. So total payment I had done was 1825. Out of it, 7 lakhs is this. So 825, a huge amount is this. Correct? Yes, correct, Vishakha. Second, anything else left out, students? Okay. Life insurance premium paid for his son who is 30 years of age and is working in US. So it means the son is not dependent on you. So my question, can you get this deduction of the insurance premium which you have paid for son who is not dependent on you? Because the son is also major, 30 years of age and also working. So it means the son is major also and not dependent on you. Do we get deduction? No, Arun, this is not 80D, it is 80C because it is life insurance. Had it been health insurance, it would have been 80D. Please be clear which section is applicable. Here 80C is applicable, not 80D, because it is life insurance. Had it been health insurance, that is mediclaim, we would have gone to 80D. Amar says yes. Anchal says yes. Arun is saying yes. Anil, so what is your answer? Simran says no. Very. So students, the answer is under 80C, whether the son is major or minor, whether the son is dependent or independent, in all cases, deduction is allowed. So you are eligible for this. Now, what about this housing loan principal? Interest we have already deducted under HP head. Now for HP head, for the principal on HP loan, the head applicable is chapter 6A, section 80C. So what is the status? Allowed, not allowed, anything special? Arun says allowed. Yes, others. Okay, then Lakshmi also says allowed. Students, the answer is it is not allowed. You know why? Because loan is taken from friend. Now, for 80C, the requirement is loan is taken from financial institutions. Students, see, these are the minute points in taxation law. See, that is why the questions which I have selected are the one which highlights these small pointers, which may otherwise, when we are reading the chapter theoretically, may get skipped. So let me just see. Repayment of housing loan taken from government or bank or LIC or only specified employer. So if you have taken loan from any other person, interestingly, 80C will not cover the deduction. Interesting. Amar, here it is not taken from scheduled bank. The loan is taken from your friend. Correct? Student, these are the small pointers that gets highlighted only when you get that type of a specific question. Yes. So the principal repayment under 80C here is not allowed because of this reason, that the loan is taken neither from government, from bank, from LIC or from specified employer. Until there are 4 or 5 things given. So it has to be either government or bank or LIC or some specified employer. It is none of these, hence it is not considered here. Correct? Understood? So section 80C, repayment of housing loan principal, not applicable. Housing loan principal is allowed as deduction under section 80C. Only a loan is taken from bank or from LIC or from government or specified. Hence, deduction under section 80C is not allowed. Understood, students? Arun, why 69D? What is the issue related to 69D here? So Anil, beta, you can check the original section. Na? So since this is a revision, let us recapitulate table, they have written etc. But etc. covers specified employers, nobody else. So Arun, how it is affecting 69D? How is 69D coming into picture, Arun? Yes. Gayatri, beta, what you want me to explain? Textile business loss. See, I have a textile business loss of how much? 470. Now we all know that business loss cannot be set off against salary and lottery. So for this 470, the incomes which I'm having, Gayatri, salary is not there. So this is out of question. HP is anyways a loss. So the only incomes I am having is capital income, and in other sources only one income, FD. Now out of these, how I'll give preference? Same rule, income which is having higher rate. Now this FD income is part of slab, and my slab already because of this salary has gone to 30%. So that is why I can use this FD, or I should use this FD first, because it is taxed at 30%, whereas capital being under 112A is taxed only at 12.5%. So I first utilize the FD income to the maximum extent possible, which was 73. Still, I have a balance loss of textile business, which now I'm setting off against long-term capital gain. There is no other option available to me because salary is not allowed, and even lottery income, betting income, gambling income are not allowed. Correct, beta? You understood this? Understood? Dhanlakshmi, PGVP is not 2 lakhs negative, HP is 2 lakhs negative, because that is what I am setting off from salary. Yes, Arun.
Sir, in case the examiner mention as the payment made for the a friend using the cash, in that case we no need to be check 69D.
No, why? You have 69D in front of you. Read.
No, sir.
Can you
Just
please?
actually after, in case the examiner that mentioned that that payment is happened using the cash. In that
Correct,
case,
beta. So, but first read 69D so that I can explain, what is where you are right and where you are wrong. So if you want it to be covered under 69D, you just read out 69D so that I'll explain where it will be covered or not. Read 69D.
6090.
You have mentioned 69D, na?
Yes.
So you have something in mind. That is why you are mentioning 69D. So read that.
Sir, if any payment other or repayment done, okay, other than the bank through Chalan, that case 6090 it will apply, right?
Correct. But are you reading it from the module, or you're just thinking aloud and telling me?
Sir, just okay. Last time I hear, okay, you
No,
only
beta. So
explained
be
that concept, so
precise.
that
Be
reason.
precise. Be
No,
precise, because
sir.
for law, we
Actually,
cannot
I don't have any
go by the.
study material now. Just I
So, beta, no
told,
problem.
I
You
had
can
just
Google
asked.
it, na? Google it and find out
Oh,
69D. Go
okay,
to
sir.
ask 69D of Income Tax Act. You'll get the Bare Act. Correct?
16.
Okay.
Yes, sir.
The next thing under ATC, student says life insurance premium of son who is not dependent. As we discussed, this is allowed, but since the question has this adjustment, we'll write a note why we are allowing it. So amount of 15,000 is allowed. Six. Under section 80C, payment of life insurance premium for major or minor and dependent or independent children, all are allowed. Correct? So students, this is the final answer. $34.77. Clear? Understood by all? I think it should be 78. Yes. Students, is this entire answer clear to you all? Yes. Super. Chalo, I'm taking a break of 10 minutes. In the meantime, we can just run through the next question. This is again of life insurance, the same point which we started, but here I've taken 4 life policies. So now this is going to be important and interesting. So read through this question. We'll discuss this after our break. Thank you. Sir, for this, so the question that is asked is, out of these, which of the life insurance policies would be exempt at the time of maturity? Now, let us analyze. So see, there is other details, but that is of no use to this question. He is a builder developer. He's having has constructed some units. Completion certificate is of this date. All that is all required if HP income is to be computed, which is not asked over here. Then further details are about his firm and partnership. Again, PGBP is not asked, so we are not getting into that. So he has taken out 4 life insurance policies. The details of the policies are as under. Now, importantly here, if you observe, this policy is issued before 2023. So here the 5 lakh limit is not applicable, but for these policies, the 5 lakh limit is applicable. Now, as we saw earlier, when we started today's deliberation, we saw the entire section which says that where the policy is taken out before 2023, you have to check for the 10% limit. If the 10% limit is satisfied, it will be exempt. If not, it will be taxable. Now see, the first policy is of 35 lakhs. 10% of this comes to 3.5 lakhs. The premium is 4 lakhs. This is exceeding 10%. It means this policy, whenever matured, will be fully taxable because it is not satisfying the 10% criterion. Now here, 5 lakhs criterion is not applicable, but anyways, that is not required because you have not satisfied the 10% itself. So that itself makes it taxable. Now coming to the remaining 3 policies, BCD. In case of BCD, let us first check the 10%. So 14 lakhs, 1.5 lakhs. Again here, it has exceeded the 10% criterion. Again, no need to see 5 lakhs. See, 5 lakhs is the second criterion. The first criterion is that it should be falling within the limit. So here the limit is how much? The limit is 10% and it is outside the limit of 10%. So therefore, this again will be fully taxable. Students, I hope you are getting this. Again, why taxable? Because the 10% limit itself is not satisfied. Third policy, 22 lakhs, 2 lakhs. This is within 10%. 31 lakhs, 3 lakhs. This is within 10%. So now we have to only think of these 2 policies. Now we have to see the premium amounts. Now the premium amount for this is 2 lakhs, which is below 5 lakhs. This is 3 lakhs, which is below 5 lakhs. So individually, both policies are eligible. Now we come to collectively whether both policies are eligible. Now for this, we will have to recall the provision. So exact total of both is 5 lakhs. Now, when the total is exact 5 lakhs, whether it will be exempt or whether it will be liable for taxability. So what is the requirement? Please read. Exemption would be available. Sorry. However, exemption would not be available if the premium payable, this we have checked. Further, exemption would also not be available if the premium payable exceeds 5 lakhs. It means exemption is withdrawn only when it exceeds 5 lakhs. No, Arun, it is not up to 5 lakhs. Had it been up to 5 lakhs, your exemption would be limited only to one of the policies. Here, our exact total is 5 lakhs, 2 plus 3, right? When will the exemption be withdrawn? When the total of the premiums is exceeding 5 lakhs. Now, in our case, the total of the premium is exactly 5 lakhs. So we are very well fitting in the exemption criteria, and hence our answer will be that this will be exempt, this will be exempt. Because the total is not exceeding 5 lakhs, it is exactly 5 lakhs. So up to 5 lakhs, exemption is available. Hence, our final answer is both these are taxable, both these are exempt. Now, what is the question asking? It is asking about taxable or exempt. It is asking about exempt. So our answer will be this. You understood this, students? Is this clear to all? Please confirm. Clear to all? If anybody has any doubts, queries, because this is a very important part, students, there is a good possibility that you may get this in your question. So Anshal, beta, I'll explain once again. So see, there are two criterions. One is the 10%, one is the 5 lakhs. But 5 lakhs has to be checked only for policies taken after, on or after 1st April 23. So 5 lakhs is not required to be checked here because this is taken before 1st April 23. So here only 10% has to be checked. Policy 35 lakhs, premium 4 lakhs, it is exceeding 10%. So you have not satisfied the 10% criterion, so it is taxable. Here 14 lakhs, 1.5 lakhs, again you are not satisfying the 10%, so it is taxable. This too, 22 lakhs, this is within 10%, 31 lakhs, this is within 10%. So both these have satisfied the 10% criterion. Now we have another criterion which is of 5 lakhs. Now individually the policy premiums are not exceeding 5 lakhs, but we have to check the total. So when multiple policies are taken, you check the total. Now the total of both these is exactly 5 lakhs. So the question arises, had it been above 5 lakhs, we would have taken exemption of only one, like how we did in the first sum, very first sum today. But here, the total is not exceeding 5 lakhs, it is exactly 5 lakhs. So on exact 5 lakhs, what is the provision? So I took you back to the provision to make you understand what the language says. What it says, exemption would also not be available if amount of premium exceeds 5 lakhs. So when will they not allow you exemption? When it exceeds 5 lakhs. Now here it is exact 5 lakhs. It is not exceeding 5 lakhs. Hence, exemption for both will be allowed. That is what is the final answer, Anshal. Anshal, I hope you understood now. Huh. Yes. Great. Anil, 15% criteria has to be checked whenever the person is physically or mentally challenged. So for them, instead of 10%, in between for a year, the premium was allowed up to 15%. See, I'll show you here. So in respect of policies issued on or after 1st April 2013, where the insurance is on the life of the person with disability or severe disability as referred to in ATU, or a person suffering from disease or ailment as specified in ATDD. Here you have that 15% criterion. So 15% will not be required in normal course. It will be required only where the person on whom the policy is taken is physically or mentally challenged. Correct? Perfect. Should we proceed, students? Chalo, now further few sums we'll do oral because I wish to cover maximum sums. So I'll not write it down because that will consume time. Now, anyways, you have understood from the previous sums how it is to be solved. So Suraj, who is aged 40 years, submits the following information for the year ending 31st March 26. He is employed in ABC and earns salary income. Now this is computed, so no need of any standard deduction. Had it not been computed, we were required to deduct standard deduction, but here it is computed, so no need to deduct any standard deduction. Correct? Fine. Is this clear, students? Next, he's engaged in speculation, non-speculation business. He earned rupees 60,000 from speculation business and suffered loss of this. So this can be set off against this. We have already seen in the previous question. So your net PGBP will be 20,000 positive. Next, he reported short-term gain of 80 and he also received lottery winnings. So both are taxable. This is taxable under capital gain. This is taxable under other sources. He has brought forward loss. Which loss? Long-term capital loss. Now, can this long-term capital loss be set off against short-term capital gain? Answer is no. So this cannot be set off. So it has to be further carried forward. Also, when you are carrying forward, you have to check if it is within the timeline. So timeline for long-term loss is 8 years. So still timeline is left. You can still carry forward it, right? Now Suraj has two children, one married daughter, age 17 years, and a son, age 16 years. So both are minors. The interest income of Riya and Raj is 1200 and 2000 per annum respectively. Now in this case, both are clubbed with his income. Now you have an exemption of 1500 each. So here the amount finally club will be nil. Here the amount club will be 500. Correct? So for 0.5, the amount to be clubbed with respect to income of Riya will be nil, and with respect to income of Raj will be 500, because you have 1500 per minor child as your exemption. Then he transferred a flat to Riya on 1st April on account of natural love and affection. This was let out from the date and generated rental income. Now, in this case, when you are transferring the house property to a minor child, whatever income the minor child is earning is clubbed with the income of the parent. So this will be clubbed in the income of Mr. Suraj. No, Dhanlakshmi, this will not come in deemed donor. It is falling in deemed donor, Dhanlakshmi. See, let us see. See, it is income of minor children, right? So for minor children, 27 is not applicable, beta. Let's see still. In case asset is transferred to minor child not being a minor married daughter without consideration or for inadequate consideration, then by virtue of 27.1, the transferor parent will be deemed owner of the house property. So when you are a deemed owner, if the minor child is not a minor married daughter. Now here, what is the question saying? Suraj has two children. Married daughter Riya. Now see, just this is for example's sake. Today, practically, this is not legally allowed, so this won't happen. But just for example's sake, what it has given, minor married daughter, because age is 17 years and she's married. Now, when you are transferring it to minor married daughter, then the situation is falling in clubbing. When it is not falling in clubbing, when it will go to 27, where the asset is transferred to a minor child, not being a minor married daughter, then by virtue of 27.1, the income is deemed to be clubbed as per 27.1, right? However, when it is a minor married daughter, 27.1 is not applicable, then you fall under clubbing. So eventually the same thing would have happened, but the effect or the section number is different. So this will also be clubbed. So your income will be into 12, so 60,000 minus standard deduction of 30%. Correct? So this will be 42,000. Again, now you have already deducted the benefit of 1500 once. You cannot deduct it twice. But here you will see you have not got the full benefit. 300 is balanced. So I'll use that 300 here, because that 300 is on account of Riya's income only. Here you could not get the entire 1500 benefit. So you deduct it here. So your final income under HP to be clubbed is 41,700. Correct? So per minor child, you have a exemption of 1500. 1200 you have used in the interest income of Riya. Balance 300 you will use in the rental income from Riya. So this will be clubbed and this will go to your HP head. Compute the total income. Assuming Mr. Suraj's income is higher. Okay. And Mr. Suraj exercises the option of shifting out. Now, since he's shifting out, we can check the deductions part. Now, what is there in the deduction part? Mr. Suraj paid a medical insurance premium of rupees 22,000 during the financial year to ensure his health, his spouse, and dependent children. So, firstly, is this eligible 22,000? If yes, under which provision? Students. Vishakha says 80C, Arun says 80D. Dhanlakshmi 80D, Simran 80D. Yes, others. Amar says 80D. Okay. Vishakha also says 80D. So correct, it is 80D because it is medical insurance premium. Now, it is paid for whom? Your own self, your spouse, and dependent children. So all conditions are satisfied. One more condition is there, it should not be in cash. So nowhere it is written, it is in cash. So it is eligible. Additionally, paid 33,000 to ensure the health of his mother, who is aged 67 years, who is not dependent on him. Now, whether mother's medical insurance premium is allowed? Because it is given, she is not dependent on her. Very good. For parents, dependency is not a condition. That was a condition only for children. So parents, even if dependent or independent, it will be allowed. 33,000 is also allowed. Now he incurred 20,000 as medical expenditure of his father, who is aged 71 years, again, who is not dependent, and he is not having a policy cover because of the age. Further, he contributed 6,000 during the year to the central government health scheme. Now see, if you remember 80D, you have to make two blocks. One is of yourself, spouse, and children. Another block is of parents. Now here you have 22 plus 6. You have 28. For parents, it is 33 and 20. Now, why to make two blocks? Because there are two separate limits. Now, since parents are dependent, for them the limit goes to 50,000. And for yourself, spouse, and children, since no one is dependent, so the amount of deduction is 25 and 50K. Students, is this clear? Is this understood? Yes. Great. So students, I have tried to cover maximum possible adjustments in whatever sums we have solved. I've covered all the topics together: deductions, clubbing, set off, some part of exemption, some part of other sources. Anyways, that will happen in income tax. You cannot have topics which are completely independent of other. Nee, Gayatri, 50,000 is not the limit for both. It depends upon whether the person for whom you are doing this expenditure is senior or not. Now, in the block of self, spouse, and children, no one is senior. So here you don't get 50,000 limit. But in parents block, they are senior. So you get the 50,000 limit here. Right, Beda? So here you cannot claim 50,000 because no one is senior here. I hope my point is understood by you. Correct? Fine, Gayatri? Great. Achha, you are saying 50,000 for each parent? No. No. 50,000 is not for each parent because there are two blocks. First covers three people, yourself, spouse, children. Collective limit for the block is 25 or 50 if someone is senior. Second block is of parents, which includes both mom and dad. And again, the collective limit of both is 50. So the limits are collective for that group, for that block, not for each person. Correct, beta? Garvo, beta, what is your question? Question 1 was very simple today. It was dealing with the insurance policy case, which we have just discussed here also. Same thing was in question 1, though at a smaller level, because in question 1, there were only two policies, A and B. Both were taken after 1st April 23. So we first checked whether it is 10%. Yes, it is 10%. total was exceeding 5 lakhs. So the rule that we studied was Garva, any one of them would be allowed. Yes, Arun. So that is what is the case. No? So where policy is not given due to age, then in that case, you can claim medical expenses, which we have done for father. Because see, the purpose of mediclaim is covering your expenses on medical treatment. Now, either I could take the policy, so I have paid premium on policy and got the deduction. If not, I have paid the medical expense. So in any case, for one of the two, I will get the deduction. So if there is no policy, because it is not allowed, then I will get the deduction of the medical expense directly. If there is a policy, I'll get deduction of the medical premium. Fine, Arun? Okay, great. So students, with this, we can conclude our today's session. I'm sure you could grab on many of the pointers which I tried to cover through all these questions. I tried to include majority of the provisions in these questions, and I'm sure that would have helped you a lot. So with this, we conclude our today's session. So thank you very much. We connect again in the next class with next topic. Until I'll check with the notes, or I'll do one thing, I'll upload it again today, and I'll also talk to the technical team. So in case if they are not available, they will be made available. I'll upload it today again, Anshul. Fine. Excellent. Thank you all. Please practice. Please be in touch and practice so that you can raise your questions in the next class, which is very important, students, because I only solving and you only listening to me or solving along with me will not be much helpful, because when I'm solving, I'm giving you the clues, I'm taking you to the respective section or the chapter. When you solve, the first biggest question is which section, which chapter you have to refer, and that you will get to know only with regular practice. Correct? Thank you. Thank you very much. Good day. Bye bye. Yes, Ashok ji, thank you very much to you also, sir. Good day. Good night.